Hello students, I Dr. Masroor Ahmed Beg, Principal Zakir Hussain, Delhi College, heartily welcomes you all to this online session on money and banking. Through this session, I will explain you first the detailed concept of money, its demand and supply and the effects on the economy, then brief you about the banking sector in India and lastly introduce with the new dimension of green finance. Let us quickly run through what we are planning to do today. Concept of money, motives of holding money, e-money, factors affecting demand for money, RBI, the money supply and the economy, money multiplier, adding a new dimension, open market operations and money supply. What is velocity of money? Velocity of money and the economy, banking sector in India, bank's balance sheet, adding a new dimension, concept of green finance in India. Let us start with the concept of money. Concept of money, what is money? How would you describe the term money as the rupee or the dollar or euros? The simple answer is no, these are mere currencies, or in other words, these are the examples of money, and so is the case of various short term financial instruments which are highly liquid. This implies that we can define money as a highly liquid financial asset which is generally accepted as a medium of exchange of various goods and services, a unit of account, and that can be stored as a wealth or as a store of value. Thus, characteristics feature of money can be described as follows. It is highly liquid financial asset. For instance, when you prepare a balance sheet of any business concern, the current assets on asset side are recorded in order of liquidity, and cash in hand is the first item, followed by cash in bank and then marketable securities and so on. It acts as a medium of exchange of goods and services. For instance, you pay for your mobile phone bills or other utility bills and your groceries or buying a new car for money. Just think how complicated the life would become if there were no money. Without the money, all economic transaction would be in form of barter system, where you exchange goods and services for other goods and services. Money as a unit of account, as it is the basic yardstick for measuring economic value. Money prices are actually relative prices. A money price, say rupees 25 for a chocolate bar, conveys the information of a relative price. One chocolate is equal to 25 times of 1 rupee, because money is both our unit of account and our medium of exchange. When you think of rupees 25, you think of what these rupees will buy. If a sandwich costs rupees 50, you can compare chocolate and sandwich, that is, one chocolate is equal to half of a sandwich, without making the relative price calculations explicitly as a store of value. Money is a way of holding wealth. For example, the miser who stuffs cash in his mattress or buries gold coins and ornaments under the old banyan tree in his backyard loan is holding wealth in money form. Similarly, in modern times, when you maintain cash balance in your bank account implies that you are holding part of your wealth in the form of money, but it is not the only store of value. There are numerous other ways of holding wealth, such as owning stocks, bonds, or real estate. Motives of holding money. Money is not giving you any interest, but bonds do offer you a good rate of interest. Still, we hold money. Keynes had further categorized the reasons of holding money on the basis of the following motives. Transaction motives. Money allows you to buy things, you can spend money. You cannot spend bonds. You can change a financial asset into spendable money, but that take time and efforts. The need to hold money for spending is called the transaction motive. Precautionary motives. Second, you hold money for emergencies. For example, if your car breaks down, you will need cash to get it towed, knowing that there will always be unforeseen needs. You might carry rupees 5,000 cash in addition to what you would otherwise carry. Holding money for unexpected expenses and impulse buying is called the precautionary motive for holding money. A speculative motive. The third reason for holding money is the speculative motive. The speculative motive is holding cash to avoid holding financial assets whose prices are falling. It comes about because the price of financial assets such as bonds varies in value as the interest rate fluctuates. For example, if you expect the price of a bond or any financial asset to fall, then bond is not something you would like to hold because you will be losing money by holding it. You would rather be holding money. In a sense, you are speculating about what the future value of the bond will be. That is why it is called the speculative motive for holding money. Thus, your money holding might not be earning any interest, but at least their value is not falling like the price of the asset. You hold money rather than longer term financial assets. So, you do not lose if asset prices fall, and of course, if financial assets prices are expected to rise, then you want to reduce your holdings of money and increase your asset holdings. E-money is represented by private money as represented by a claim on the issuer, which is number 1 stored on an electronic device, number 2 issued on receipt of funds, and number 3 accepted as a means of payment by persons other than the issuer is another new method of payment. It can be used to pay for purchase on the internet. You open an account by transferring funds to the issuer of the e-money. Then when you are shopping online, you instruct the issuer to send your e-money to the merchant. Please note the fact that credit cards are nowhere to be seen in a list of the components of money. Credit cards are not money. Credit cards are not a financial liability of the bank that issues them. Instead, credit cards create a liability for their issuers, that is money owed to the company or bank that issued the card, and the banks have a financial asset as a result. While credit cards are not money, a debit card serves the same purpose as a check. Think of it as a computer check book and hence is money. It allows you to spend money in your bank account to debit your account and thus makes your bank account more liquid. With a debit card, no loan is involved. you are spending your money. Factors affecting demand for money. Factors that influenced the demand for money are discussed as 1. Inflation. During the inflationary periods, people need to hold an increasing amount of money to meet their day-to-day expenses. Number 2. Income. The more you make, the more you spend, and the more you spend, the more you need to hold as cash or in your bank account. As income rises, so is the demand for money. Balances also rises. Number 3. Interest rates. There exists an inverse relationship with the interest rates to the demand of money. As interest rates rises, people tend to invest more to make more money and consume less. So, the demand for money falls. Number 4. Credit availability. As credit availability increases or it is easy to avail credit with more flexible policies, then people tend to hold less money and therefore, demand for money falls. RBI, the money supply and the economy. The Reserve Bank of India is the central bank of the India, responsible for framing the monetary policy, which means that a country's central bank determines how much money circulates in the economy. In other words, RBI is the responsible for the issue and supply of the Indian rupee and the regulation of the Indian banking system. It also manages the country's main payment system and works to promote its economic development. The total stock of money in circulation among the public at a particular point of time is called money supply. The measures of money supply in India are classified into 4 categories: M1, M2, M3 and M4 along with MO. This classification was introduced in April 1977 by Reserve Bank of India. The reserve money MO, it is also known as high powered money, monetary base money, etc. MO is equal to currency in circulation plus bankers deposits with RBI plus other deposits with RBI. It is the monetary base of economy. Narrow money M1 is equal to currency with public plus demand deposits with the banking system, current account, saving account plus other deposits with RBI. M2 is equal to M1 plus savings deposit of post office saving banks. Broad money, that is M3 is equal to M1 plus time deposits with the banking system. M4 is equal to M3 plus all deposits with post office savings banks. The liquidity means how fast an instrument can be converted into cash. The liquidity of these measures is in order: M1 is more than M2, M2 is more than M3, M3 is more than M4. That is, M1 is most liquid and M4 is the least liquid. Money multiplier is equal to 1 divided by reserve ratio. It is the relationship between monetary base and money supply in economy. The amount money that banks generates with each unit rupees in case of India of money, it is the ratio of deposits to the reserves in the banking system. In other words, the measures of the amount of money ultimately created per dollar deposited in the banking system. When people hold no currency, it tells us how much money will ultimately be created by the banking system from an initial inflow of money. The higher the reserve ratio, the smaller the money multiplier. For instance, if R is equal to 10%, then money multiplier is equal to 1 divided by 0.10, which is equal to 10. Had the bank kept out 20% each time, the money multiplier would have been 1 divided by 0.20, which is equal to 5. If reserve ratio were 5%, the money multiplier would have been 1 divided by 0.05 is equal to 20. The higher the reserve ratio, the smaller the money multiplier and the less money will be created. To understand the entire process of creation of money, for example, let us say total deposit in banking system is rupees 100 million and reserve ratio requirement is 10%. The banks can lend 90% of deposit, that is rupees 90 million. These rupees 90 million that banks will lend to its customers will ultimately be deposited in another bank, which can further lend 90% of that is rupees 81 million, and cycle continues. The money supply is all the currency and other liquid instruments in a country's economy on the date measured. The money supply roughly includes both cash and deposits that can be used almost as easily as cash. Government issue paper currency and coin through some combination of their central banks and treasuries. Bank regulators influence money supply available to the public through the requirements placed on banks to hold reserves, how to extend credit and other regulation. Economists analyze the money supply and develop policies revolving around it through controlling interest rates and increasing or decreasing the amount of money flowing in the economy. Public and private sector analysis is performed because of the money supply's possible impacts on price level, inflation and the business cycle. Effects of money supply on the economy. An increase in the supply of money typically lowers interest rates, which in turn generates more investment and puts more money in the hands of consumers, thereby stimulating spending. Business respond by ordering more raw materials and increasing production. The increased business activity raises the demand for labor. The opposite can occur if the money supply falls or when its growth rate declines, adding a new dimension. Open market operations and money supply. A central bank's RBI primarily responsibility is making monetary policy, which involves decisions about the appropriate size of the economy's money supply. Suppose that the RBI wants to increase bank reserves with the ultimate goal of increasing bank deposits and the money supply. To accomplish this, the RBI buys financial assets, usually government bonds, from the public. To simplify the actual procedure a bit, think of the RBI as buying bonds that the public had originally purchased from the government and paying the public for these bonds with newly printed money. Assuming that the public is already holding all the currency that it wants, they will deposit the cash they receive as payment for their bonds in commercial banks. Thus, the reserves of the commercial banking system will increase by an amount equal to the value of the bonds purchased by the RBI. The increase in bank reserves will lead in turn through the process of lending and redeposit of funds to an expansion of bank deposits and the money supply. The RBI's purchase of government bonds from the public, with the result that bank reserves and the money supply are increased, is called an open market purchase. To reduce bank reserves and hence the money supply, the RBI reserves the procedure. It sells some of the government bonds that it holds acquired in previous open market purchases to the public. Assume that the public pays for the bonds by writing checks on their accounts in commercial banks. Then when the RBI presents the checks to the commercial banks for payment, reserves equal in value to the government bonds sold by the RBI are transferred from the commercial banks to the RBI. The RBI retires these reserves from circulation, lowering the supply of bank reserves and hence the overall money supply. The sale of government bonds by the RBI to the public for the purpose of reducing bank reserves and hence the money supply is called an open market sale. Open market purchases and sales together are called open market operations. Open market operations are the most convenient and flexible tool that is being used for affecting the money supply and are employed on a regular basis. Let us say currency held by the public is rupees 1000, bank reserves are rupees 200 and the desired reserve deposit ratio is 0.2, that is 200 divided by 1000. What is the money supply? How is the money supply affected if the central bank prints rupees 100 and uses this new currency to buy government bonds from the public? Assume that the public does not wish to change the amount of currency it holds. Money supply is equal to currency held by the public plus bank deposits. Also, bank deposits equal to bank reserves divided by desired reserve minus deposit ratio. Then substituting equation 2 in equation 1, we get money supply is equal to currency held by public plus bank divided by desired reserve minus deposit ratio. As bank reserves are rupees 200 and the reserve deposit ratio is 0.2, then bank deposit must equal rupees 200 divided by 0.2 is equal to rupees 1000. The money supply equal to the sum of currency held by the public and bank deposits is therefore rupees 2000. The open market purchase puts 100 more rupees into the hands of the public. We assume that the public continues to want to hold rupees 1000 in currency. So, they will deposit the additional rupees 100 in the commercial banking system, raising bank reserves from rupees 200 to rupees 300. As the desired reserve deposit ratio is 0.2, multiple rounds of lending and redeposit will eventually raise the level of bank deposits to rupees 300 divided by 0.2 or rupees 1500. The money supply equal to rupees 1000 held by the public plus bank deposits of rupees 1500 equals rupees 2500. So, the open market purchase of rupees 100 by raising bank reserves by rupees 100 has increased the money supply by rupees 500. What is velocity of money? The velocity of money is a measurement of the rate at which money is exchanged in an economy. It is the number of times that money moves into from one entity to another. It also refers to how much a unit of currency is used in a given period of time. Simply put, it is the rate at which consumers and businesses in an economy collectively spend money. The velocity of money is usually measured as a ratio of gross domestic product GDP to a country's M1 or M2 money supply. In other words, velocity is a measure of the speed money changes hands in transactions from final goods and services. The velocity of money is important for measuring the rate at which money in circulation is being used for measuring goods and services. It is used to help economists and investors gauge the health and vitality of an economy. High money velocity is usually associated with a healthy, expanding economy. Low money velocity is usually associated with recessions and contractions. Velocity of money is a metric calculated by economists. It usually the rate at which money is being transacted for goods and services in an economy. While it is not necessarily a key economic indicator, it can be followed alongside other key indicators that help determine economic health like GDP, unemployment and inflation. GDP and the money supply are the two components of the velocity of money. Formula: economies that exhibit a higher velocity of money relative to others tend to be more developed. The velocity of money is also known to fluctuate with business cycles. When an economy is in an expansion, consumers and businesses tend to more readily spend money, causing the velocity of money to increase. When an economy is contracting, consumers and businesses are usually more reluctant to spend and the velocity of money is lower. Since the velocity of money is typically correlated with business cycles, it can also be correlated with key indicators. Therefore, the velocity of money will usually rise with GDP and inflation. Alternatively, it is usually expected to fall when key economic indicators like GDP and inflation are falling in a contracting economy. Examples of velocity of money: consider an economy consisting of two individuals, Mr. A and Mr. B, who have rupees 1 lakh cash each. Mr. A buys a car from Mr. B for rupees 1 lakh. Then Mr. B purchases a home from Mr. A for rupees 1 lakh. Mr. B has kids and enlists Mr. A's help in adding new construction to his home. For his efforts, Mr. B pays rupees 1 lakh. Mr. A also spends a car he owns to Mr. B for 1 lakh. Thus, both parties in the economy have made transactions worth rupees 4 lakhs, even though they only possess rupees 1 lakh each. In this economy, the velocity of money would be 2 resulting from rupees 4 lakhs in transactions divided by the rupees 2 lakhs in money supply. This multiplication in the value of goods and services exchanged is made possible through the velocity of money in an economy. Velocity of money and the economy. There are differing views among economists as to whether the velocity of money is a useful indicator of the health of economy or more specifically inflationary pressures. The monetarists who subscribe to the quantity theory of money argue that money velocity would be stable absent changing expectations, but a change in money supply can alter expectations and therefore, money velocity and inflation. For example, an increase in the money supply should theoretically lead to a commensurate increase in GDP prices, because there is more money chasing the same level of goods and services in the economy. The opposite should happen with a decrease in money supply. Critics, on the other hand, argue that in the short term, the velocity of money is highly variable and prices are resistant to change, resulting in a weak and indirect link between money supply and inflation. Velocity of money is equal to GDP divided by money supply. GDP is usually used as the numerator in the velocity of money formula, though gross national product GNP may also be used as well. GDP represents the total amount of goods and services in an economy that are available for purchase. In the denominator, economists will typically identify money velocity for both M1 and M2. M1 is defined by as the sum of all currency held by the public and transaction deposits at depository institutions. M2 is a broader measure of money supply, adding in savings deposits, time deposits and real money market mutual funds. For instance, let us calculate the velocity in India 2019. M1 is equal to rupees 2370 billion, M2 is equal to rupees 11,425.3 billion. Nominal GDP is equal to rupees 18,960 billion. Using M1, velocity is 8.00, V is equal to rupees 18,960 divided by rupees 2,370 equal to 8.00. Using M2, velocity is 1.66, V is equal to rupees 18,960 divided by rupees 11,425.3 is equal to 1.66. Banking sector in India. The Indian banking system consists of 20 public sector banks, 22 private sector banks, 44 foreign banks, 44 regional rural banks, 1542 urban cooperative banks and 94,384 rural cooperative banks in addition to cooperative credit institutions. Banks balance sheet. Bank balance sheets report the assets, liabilities and the bank capital for an individual commercial bank. The balance sheet accounting equation is asset is equal to liabilities plus capital. The assets are items that the bank owns. This includes loans, securities and reserves. Liabilities are items that the bank owes to someone else, including deposits and bank borrowing from other institutions. Capital is sometimes referred to as net worth, equity capital or bank equity. Bank capitals are funds that are raised by either selling new equity in the bank or that come from retained earnings, that is profits. The bank earns from its assets net of liabilities. The following is an example of a commercial bank's balance sheet. The balance sheet of the Reserve Bank plays a critical role in the functioning of the country's economy, largely reflecting the activities carried out in pursuance of its currency issue, function as well as monetary policy and reserve management objectives. Below is the stylish central bank balance sheet, adding a new dimension, concept of green finance in India. The impact of climate change on the financial system manifests through various risks, inter alia, loss or damage to tangible assets arising from frequent natural disasters and financial instability, implication emanating from volatility in food prices, due to erratic weather trends. Elevated credit spreads and greater precautionary savings. Enormous amounts of investments are required to combat climate change and bring about a transformation towards sustainable and low carbon development. As public funding alone cannot finance the necessary transformation required to address climate change. Green finance is required to be harnessed for financing environment friendly sustainable development. The green finance ecosystem seeks to raise financial flows from banking, microcredit and insurance sectors, as well as from public, private and not for profit sectors. Central banks can use several policy tools for climate change mitigation, including disclosure requirements relating to all climate related financial risk, green macro prudential regulations such as higher risk weights for carbon intensive sectors, differentiated capital and reserve requirements for banks with higher green lending and green credit policy, instruments in the form of subsidized loan rates for priority sectors, UN Environment 2017. In the Indian context, preliminary estimates conducted for Paris Agreement suggest that at least US dollar 2.5 trillion at 2014-15 prices will be required for meeting its climate change actions between 2015 and 2030. Government of India 2015. India's ambition of generating 175 gigawatts of renewable energy by 2022 also entails massive funding. As early as 2007, the Reserve Bank emphasized the need for non-financial reporting and urged financial institutions to adhere to sustainable development practices. Banks in India have been sensitized to the various international initiatives, including the Equator Principles. In 2015, the Reserve Bank included lending to social infrastructure and small renewable energy projects within priority sector lending targets, thereby giving a further fillip to green financing. Notwithstanding this progress, the development of green finance faces many challenges such as greenwashing or false claim of environmental compliance, plurality of green loan definitions and maturity mismatches between long term green investment and relatively short term interest of investors. Policy action is needed to establish an enabling framework that promotes the green finance ecosystem in India by fostering awareness through coordinated efforts, deepening of corporate bond market, standardization of green investment terminology, consistent corporate reporting and removing information asymmetry between investors and recipients can make a significant contribution in addressing some of the shortcomings of the green finance market. Now, we have reached the end of today's session. I hope that you understand and enjoyed the lecture. Let us just quickly run through what we did today. Concept of money, motives of holding money, e-money, factors affecting demand for money, RBI, the money supply and the economy, money multiplier, adding a new dimension, open market operations and money supply. What is velocity of money? Velocity of money and the economy, banking sector in India, banks balance sheet, adding a new dimension, concept of green finance in India. That is all we have for you today. Goodbye and take care.